Welcome to our daily Market Edge Explainer, where we cut through the noise to give you the clarity you need. And right now, the entire market is holding its breath for one single thing. We're going to break down why Nvidia's earnings report is such a high-stakes event and what it could mean for, well, pretty much everything.
Okay, let's just jump right in with this number, 7%. That's the massive swing the market is pricing in for Nvidia's stock after its earnings report. Now, for a company with a market cap over $2 trillion, a move like that isn't just a ripple, it's a potential tsunami that could wash over the entire market.
But look, Nvidia is just one piece of a much bigger puzzle. To really get what's going on, we're going to look at 5 key themes driving the markets. We'll start with the main event, then get into the mix of AI, politics, and some huge money, take the market's anxious pulse, check out crypto's outflow problem, and wrap up with a potential dangerous divergence.
So, first up, the Nvidia earnings gamble. And let me be clear, this isn't just another quarterly report. This is the event. This is the one that could set the tone for the entire market in the coming days. The stakes just couldn't be higher, and everyone is watching.
Now here's where it gets really interesting. Despite all the high-stakes drama, if you look at prediction markets like Polymarket, traders are giving it a 66% probability that the stock will actually rise after the results are announced. It's no guarantee, of course, but that's a pretty strong signal of bullish confidence. So here's how this is all going to go down. The report drops right after the U.S. market closes. The first real taste we'll get of the market's reaction will come from overnight futures and especially pre-market trading tomorrow. That's when we'll find out if that 7% move is going to be a boom or a bust.
All right, moving on. The hype around Nvidia isn't happening in a vacuum. It's actually being supercharged by some massive political and financial forces converging on the whole AI space.
First, you've got the political angle. There's chatter about invoking a national defense law for AI, with Trump's name attached to the idea. Now, what would that actually mean? It could mean a massive infusion of government cash into a few select AI projects, which would be a complete game changer for any company involved. And then, there's the money. Just look at this number, $1 trillion. That's what Saudi Arabia is reportedly getting ready to announce as an investment plan just for American AI companies. That is a tidal wave of capital that's about to hit the sector. So while the AI sector is absolutely booming, the rest of the market is sending some pretty anxious signals. We're seeing some conflicting stuff that points to a much more cautious mood out there.
You know, it's really a tale of two markets right now. On one hand, you've got smaller companies, the small caps, that are actually doing pretty well. But then you look at the giants, the mega caps that usually lead the charge, and they're stumbling. That kind of split is a classic sign of weakness under the surface, and it's making investors pretty nervous.
And this weakness isn't just a vibe. It's rooted in some very real economic pressures. Consumers are pulling back on big purchases, the credit markets are showing stress, and the job market seems to be cooling off. You put it all together, and it's no surprise the S&P 500 has been on a 4-day losing streak.
And this anxiety isn't just staying in the stock market. Nope, it's spilling right over into the crypto world. We're seeing a really significant and sustained outflow of institutional money there.
The big headline here is BlackRock. They pulled a massive $523 million from their Bitcoin ETF. And yeah, Grayscale saw some money come in, but it was just a drop in the bucket. The net result? The 5th straight day that more money has left Bitcoin ETFs than has come in.
And it's not just a Bitcoin story. Ethereum ETFs also took a hit. And again, BlackRock was the main driver. But hey, it's not all doom and gloom. Fidelity's new Solana ETF had a pretty decent start, pulling in a modest $26 million.
But this all might be pointing to a much bigger story. There's a trend that's been developing for weeks now, and it could have major implications for the entire market. We need to connect the dots here.
What we might be seeing is something called the Great Divergence. So, think of it this way. Usually, the amount of money floating around the world, global liquidity, and the price of risky assets like Bitcoin, they move together. They're dance partners. But right now, they're heading in opposite directions, and that is a major red flag.
The theory is that Bitcoin was the canary in the coal mine. It peaked back in early October, and its decline was a warning sign that liquidity was tightening up. The logic is simple, right? If there's no new money coming in, people stop spending on risky assets. And sure enough, just a few weeks after Bitcoin peaked, the Nasdaq started to slide too.
So this leaves us with the million-dollar question, or maybe the trillion-dollar question. With everybody completely obsessed with Nvidia, is the market missing the bigger picture?
Is Bitcoin screaming a warning sign that the easy money party that has fueled this whole run is finally starting to end? If you found this explainer helpful, be sure to smash that like button and subscribe so you don't miss your next daily edge. More news in our Telegram channel in the first comment. See you next time.